Hello, welcome back to a weekly market recap with Knight this week. Let's jump into it. So this past week, we saw the market up 1.94% in the S&P 500. We're still down year to date 18.19%. In the NASDAQ, we're actually up 4.54% this week, but we're still down 25.64% year to date. So let's talk about why the market was positive this week. The biggest data catalyst actually came out on Friday, and it was the jobs data for June. But let's jump into the market and see what happened. So we started the first trading day of this week on Tuesday. It was a short week, and we actually saw a pretty steep sell-off, but a recovery before the end of the day. And then throughout the rest of the week, a steady rise up until Friday, which was really our biggest catalyst day, which was, again, we were waiting for the June jobs data that came in. Again, we're kind of in this situation where if the jobs data looks too good, then we're afraid that the Federal Reserve is going to have to come in and raise rates even higher. They have the runway to do more 75 basis point hikes. But if the jobs data is too bad, then we're really afraid of a recession. So at first, what happened is the data came in this morning, and we saw a pretty steep sell-off. And then there was kind of a reversal throughout the day. And so I'll talk about that for a little bit. So jobs data came in. We added about 370,000 jobs. The expectation was for around 260,000 jobs. So high level, at first, that's panic, because all of a sudden we just added way more jobs. Wait a minute, the labor market is way stronger, still tight. Unemployment still at 3.6%, and that's a lot tighter than the Fed feels that it needs to be. That gives them more room to tighten more, faster, whatever it looks like, more pain for the stock market. So at first, if you just look high level at those numbers, there's a little bit of fear. But as soon as you start to jump into the numbers a little bit more, we actually see that for the past 2 months, they revised those numbers down to the tune of about 70,000. So we beat by 100,000 this month, but we actually revised down for the last 2 months by 70,000 jobs. So it really only beat by 30,000 if you combine all 3 months. And a 30,000 beat versus a 100,000 beat means that the labor market might be as tight as the Federal Reserve wants. In addition, if you go through the different sectors that were adding jobs and not, we did see a large boom in hospitality and some of these summer areas that we would expect to have a larger impact. But overall, we're not necessarily seeing a broad-based add to all locations. And thus, we do think that the labor market is actually still tightening in respect to how the Fed wanted. And I think that's one of the main reasons why we saw a reversal in the day. At first, we started to fall. And then I think as investors, people in general started to digest it a little bit more, they said, okay, this might not be as bad as we initially thought. We might be still in the realm of tightening, but not to the extent that we're going to send everything into a deep recession. But we're also, the labor market's not flying away, so the Fed can tighten a whole lot more. Kind of one of those Goldilocks scenarios. Now, that was the big data catalyst for this week. Next week's a huge week for the market because we're going to be getting the CPI read. And as we know, inflation is still hot. It's still on the mind. And one of the issues that we're facing right now is we had a really bad read last month, and the expectations are a worse read for this month. So the June inflation is the expectations are around 8.8% year over year inflation. That's even worse than what we had at 8.6%. last month. Now, people are hoping that June data given in July will be the peak, but we could be in for a really rough week next week if we either miss and we're in 9%, that would be really bad, or even if we just come in with expectations. Again, that could be the sign that the Fed has to raise interest rates again at 75 basis points or even maybe higher. Really, inflation is the biggest thing on investors' minds right now. It's what's controlling the Fed. And so if inflation gets under control, we could see a really positive reversal or switch to the upside. But again, as long as inflation is top of mind bad and it's broadening out like we saw back in June from the May reading, we will still continue to probably see some pain until those numbers start to come down. Then the Fed can relax a little bit. And then I think we will see a deeper or a more sustained market recovery. Anyways, know this is a little bit shorter this week, but appreciate you guys. And as always, we're here to support you. Your Money's here to support you. We'll see you again next week.